Hey guys, welcome back to the channel. The supply and demand zones have to be one of the cleanest and most straightforward methods for analyzing charts for potential trade opportunities. I have made two very detailed videos on identifying, drawing and trading supply and demand zones along with 5 odd enhancers to filter out only the best possible supply and demand zones. An important topic of discussion in the video was the supply and demand curves, but I did not go into the finer details of this particular method. So I thought, why not make a comprehensive video on this topic to better your understanding of supply and demand zones. So let me warn you, before watching this video, it is important to understand the basics. So better watch the first video if you haven't already, and then watch this video for maximum benefit. In this video, we will talk about the supply and demand curves, how to identify supply and demand curves, and how to trade profitably using the curve. So I need at least 500 likes on this video because it takes a lot of time and effort to provide quality content free of charge. And if you are new to the channel, make sure to subscribe and enable the bell notification so that you won't miss out on any upcoming videos. Okay then, let's get started. Supply and demand are the two dynamic forces that establish market prices. These forces are driving prices up or down based on who's in control over the market. For instance, if supply exceeds the demand, prices tends to go down as more sellers are interested in selling instead of buying the asset. On the contrary, if the demand exceeds the supply, prices tend to go up as more buyers are interested in buying instead of selling the asset or stock. So the curve is basically a tool that traders can use to determine whether the price is located near a higher time frame supply or demand zone. Now this is very important as we want to buy low and sell high in order to make a profit. Now you may ask me why I should take the trouble of drawing the curve when I can just trade using the zones and odd enhancers to get a high probability trading setup. As I have mentioned just now, the reason why we determine the curve is to avoid buying high and selling low, or in other words, to avoid buying at the supply zone or selling at a demand zone. Now this step is very crucial in trading the markets using supply and demand because our goal is to trade with the trend and not against it. So let's start off by identifying the supply and demand zones first. To identify the supply and demand zones, we will use yet another simple 3-step process. First, we will use a larger time frame to draw our zones in control and then determine the location of the current market price on the curve. So the first step is to choose your higher time frame. As you may know by now that multiple time frame analysis or multi-time frame analysis is a method of analyzing at least 2 or 3 different time frames of a particular stock or an instrument to construct a bigger picture of the long-term trend. Now the whole idea is to trade with the trend, and the multi-time frame analysis allows us to align our trades with the higher time frame trend. Now always remember that the larger the time frame, the better the chances of a successful trade. I have already made a video on the selection of time frames and multiple time frame analysis, so if you want you can check that out. Now in that video, I stated a rule on how to select time frames based on trading styles. The rule says that when you choose your time frame combination, the higher time frame needs to be at least 3 to 6 times greater than your intermediate time frame, and so on. For example, if you want to take a swing trade, your higher time frame would be a weekly chart. The intermediate time frame would be a daily chart because there are 5 days in a trading week, and when considering a factor of 5, the time frame becomes 1 day. The even lower time frame would be the 1 hour chart. However, in this video we are going to take a positional trading approach and we are going to use the monthly chart as our higher time frame. The weekly chart will be our intermediate time frame, and finally the daily chart will be our lower time frame. Now you can use any combination of time frames based on the type of trading style that you follow. The second step, however, is to identify the supply and demand zones under control. Now, the idea of the second step is to determine who's in control of the market. Is it the buyers or the sellers? Now, after we open the monthly chart, we have to start by locating the current market price. Then we need to identify the closest supply and demand zones to the current market price. In this chart, we can clearly see that the price is near the higher time frame demand zone. Now take a look at another chart where the current price is located almost in the middle of the supply and demand zone under control. The reason why we look for the location of the price with respect to the zones is that we can still take a trade entry as long as the longer time frame gives us a good profit margin to make money. Otherwise, we don't generally look to take a trade in the middle of the zone, and one of the reasons being the difficulty in the placement of a proper stop loss. Now moving on the third and final step, drawing the curve. So the third step is to divide the area between the proximal lines of the supply and demand zones under control into 3 equal areas. Now the idea is that after identifying the closest supply and demand zones, you have to divide the distance between them by 3, and we will get a high area, a low area, and an equilibrium area. There are 2 methods to divide the curve area. The first option is simply to count how many points there are between the 2 proximal lines of the zones which are under control and divide them by 3. Now the second option is to use a Fibonacci retracement tool to identify the supply and demand curves without having to divide the area manually. To draw the curve areas using the Fibonacci tool, you have to modify the settings to get exactly 3 equal areas on the chart. So all you have to do is to change the Fibonacci levels to the following, that is 0%, 33%, 66% and 100%, and you can uncheck all other levels. Now that you have changed the Fibonacci settings, you can draw the curve from the proximal line of the supply zone to the proximal line of the demand zone. The Fibonacci tool will divide the area into 3 equal zones automatically. I hope things are clear. Now let's move to the most important section, that is how to trade using these curves. So on the larger time frame that we have analyzed, the curve serves as an indicator as to whether the price is high, low or in the middle with respect to the supply and demand zones in control. Now based on this information, we can decide whether to buy, sell or do nothing. Now there can be different trading scenarios based on the curve. When the price is very high in the curve, usually inside the supply zone, our trading bias is to sell only. Now if the price is high in the curve, that is just below the supply zone but higher than the equilibrium zone, we will still look to sell only. On the opposite, when the price is very low in the curve, typically inside the demand zone, we will look to buy only. And as you may have already guessed, when the price is low in the curve, that is just above the demand zone but lower than the equilibrium area, we will still look to buy. Now what happens when the price is at the equilibrium area? Then we will have 2 options, that is either to trade with the prevailing trend or do not trade at all. Now it actually depends on how aggressive you are with your trading style. Now let's put everything together and see how we can identify the supply and demand curves and plan our trade accordingly. So the first thing we do is to begin with the larger time frame to determine the location of the current market price within the supply and demand zones in the control. This will actually give us the framework to look for trading opportunities. Once we have identified the supply and demand zones in control, you can use the Fibonacci tool to divide the area into 3 equal levels or zones as shown in the monthly chart. Now in the chart, the current market price is located between the low and the equilibrium areas of the curve, which means that our bias is only to buy as long as the trend is up. But when we zoom in on the weekly chart, we can observe how the price broke the trend line and created a new supply zone. The price then moved down and created a new demand zone, which is actually nested inside the monthly demand zone. So what we have on the monthly chart is that the price is at the low or the equilibrium area in the curve and the overall market is uptrending. But on the weekly chart, the price is moving sideways with a weekly demand zone nested inside a monthly demand zone. So if you think of selling when the price tests the weekly supply zone, then you are actually trading against the higher time frame trend, which is not our objective. So as we said in the beginning, the higher time frame always prevails. Hence, we should avoid selling from the weekly supply zone because the trend is uptrending, and on top of that, the reward to risk is not satisfactory. Instead, the ideal thing to do is to wait until the prices hit the monthly or the weekly demand zone and then look to go long. At this level, the buyers will be interested in buying more and hence pushing the prices higher. And as we can clearly see, the prices went back down to the weekly or monthly demand zone and then rallied to the monthly supply zone, which actually provided a low risk, high reward trade. So as long as we trade with the long term trend, we are safe. Now let's take a look at another example. On the monthly chart, the current market price is high on the curve. This means that our bias is only to sell from the fresh supply zones on lower time frames. Now zooming in on a weekly chart, we can observe that the price is moving up and creating new higher highs and new higher lows. We can also draw a trend line connecting the two higher lows together which indicates that the trend is towards the upside. On the same weekly time frame chart, we will draw our supply and demand zones to align with our views with the monthly chart, which is the higher time frame here. So when we do that, we get a weekly supply zone which is nested inside the monthly supply zone. This means that this weekly supply zone will have a higher probability of success because it overlaps with a higher time frame zone. Now the same thing applies to the demand zone down at the bottom of the chart. Now these nested or overlapping zones have a higher probability of success because the higher time frame zones are more powerful than the lower ones. Now that we know the price is high in the curve and the trend is up, we need to find a supply zone to place our entry and stop loss accordingly. So we don't just buy in the demand zone because the price is high in the curve. Also, we have to notice that the price is near the monthly supply zone, which means that soon the price will reverse down and pierce all the demand zones that are up in the curve. So in order to buy, we can either use the weekly chart or use an even lower time frame like the daily to find a suitable entry zone. So if the weekly zone is obvious, as in this example, we can just stop our analysis here and place our entry right at the proximal line of the weekly supply zone. But if the weekly supply zone gives us a larger stop loss that we cannot handle, or if the zone is not giving us a clear entry point, then moving down to a lower time frame is the ideal thing to do. So on the lower time frame chart, we have a nested daily supply zone within the weekly supply zone. Now this has become a high probability zone to trade in. We can place our entry at the proximal line and place our stop loss above the distal line. To exit the trade, we can place our target at the opposite demand zone. The profit margin is good as we have at least a 3:1 reward to risk ratio in this particular trade. And as you can see, the price hit our entry level at the proximal line and dropped all the way down to our target, giving us a very good trade. From this particular example, you can also notice how the risk changes from monthly to daily supply zones. So if we were to trade the monthly zone, we would have placed a larger stop loss and the price would almost pierce half of the zone before reversing back down compared to the weekly and daily supply zones. So it is always a great idea to use multiple time frames and trade on a particular time frame that gives you the best trading setup. You can use any set of time frame as you wish. So if you are an intraday trader, you can use a combination of daily, hourly and 15-minute charts to conduct the analysis and find the zones in control, draw the curve and identify if there is a trade opportunity in the direction of the existing market trend. Now you have to combine what you have learned in this video with the previous two videos to execute a profitable trade. Now that is all for this video. I hope this video gave you even deeper insight into how to deal with the supply and demand zones. So just keep learning, keep practicing and keep trading. If you find this video helpful, please drop in a like. And if you are new to the channel, press the subscribe button to join our community and enable the bell icon to get all new video updates. I will see you guys in the next video. Till then, see you.